capital. Now let's start with the third part and see that how this chapter is going to be end. Uh, okay, so part three is dealing with the which we mention right offerings, that how do we offer rights and why. So the first part is talking about venture capital. That's a way of getting very initial stage capital raising, and then public offering to go one step ahead by selling to the public. And in the public offering, the underwriter is a very important, and how the underwriter operates, and there are different ways that we do underwriting for our public offerings. And now we are focusing on right issue, that how we issue or raise our capital by issuing our stocks to the existing stockholders. In this case, we don't need an underwriter, so we are saying that right offers. Right offerings are a basic concept issue of common stock offered to the existing shareholders. Uh, Also, current shareholders, to avoid the dilution can occur with the new stock. So when the new stock is issued, there is a problem. That problem we call it as a dilution. Means that and it's understandable in the sense that if there's a business and owned by two people as a partners, so if they add a one new partner, what is going to happen? That the dilution, their ownership is reduced from one half to one third, and if they add one more, so one half to one fourth. So that's the dilution of the ownership of the securities if there is a more shares are issued, right? So allow current shareholders to avoid the dilution that occurs with a new stock. So if we issue new stocks to the other people, to the public, so there's the existing shareholders feel this, that there is a dilution in their ownership. So in order to avoid that dilution, what they do, they say, okay, you are the existing, so you have the first right, you buy it, more shares. So by this way, there is no dilution effect, but you will get more stocks, and the firm will get a capital. So rights are given to the shareholders. Specified number of shares can be purchased. So right is not like an open-ended or an open offer that you can buy. No, it's like fixed number. Like if that is possible, that if you own a one stock, you can get a one more share. So if you own a one share, you can buy one share, or if you own a 5 shares, you can buy one share. So this is the way that how much they want to issue the right shares, and they divide it towards the existing shares. So calculate the proportion, like how much. Sometimes it happens that if you own 2 shares, you are able to buy one share. If you own 5 shares, then you can able to buy one share. It depends on the number of shares that they want to issue. Specify purchase price. Definitely, you are going to offer them a price which is different than the market price, current market price. The reason why the existing shareholder is going to exercise the right is only that if he is going to get some benefit. So specified time frame as well, like how much time is available to exercise that right. Because right is given to, okay, you can buy you are not forced to, you are just given the option that, okay, if you are existing shareholders, so you can buy one share against one share at this price during this period. If you exercise this option, well and good. If not, so then it's going to be last. So it's not going to be stay forever, right? Usually made on the same exchange as the company's stock. The value of a right. The price specified in a right offering is generally less than the current market price. I just told you that. The share price will adjust based on the number of new shares issued. Definitely, after the right issue, the price is going to be adjusted in the market, and very commonly it is observed that it's going to go down. The value of the right is the difference between the old share price and the new share price. Now, this is an example. Suppose a company wants to raise 10 million, and this is a good example to understand the right issue. The subscription is 20, and the current market price is 25. The firm currently has 500,000, 5 million shares outstanding. How many shares have to be issued? And how many rights will it take to purchase one share? And what is the value of a right? So these are the questions we have to answer. So first of all, the question is how many shares have to be issued? Now they want to raise 10 million, right? They want to raise 10 million. So the number of new shares to be issued, funds to be raised, this is 10 million. And what is the subscription price? $20. So we divide this 10 million with $20. So we see that, okay, there is a need that they have to issue 500,000 new shares, right shares. The second question is saying, how many rights will it take to purchase one share? Now, already existing are the 5 million shares, right? 5 million shares. And they want to issue 500,000, right? 0.5 million shares. So how we can calculate this? How many rights will, so we divide this 5 million with the 500,000, so 10. So the number of right to purchase one new share is 10. So if you have a 10 shares already, then you are able to buy one share, one new share, right? What will be the value of a new share? So the value of a new share, to find out the formula, is market price minus right now. M0 means right now what is the market price minus subscription price, which is $20, divided by n plus 1. N is 10, right? 10 plus 1. So you see here, we get it 25 minus 20, which is 25 is the market price, subscription price is 20, divided by 10 is the right, plus 1 is 11. So when we divide 5 with 11, we get it $0.45. So what is the value of a right is $0.45. And if you multiply it with a 10, you see that. Now, the effects of right on stock price, there is an X right. There are some dates when a firm is issuing right. We call them an X right. The price of the stock will drop by the value on the day that stock no longer carries the right. So the price go down because now there is a more shares in the market. So there is an announcement date for a right. And there an X right date means that if they are saying that, okay, we are going to give you a 40 days to exercise your right. So right, you see announcement date is September 30th and X right date is October 13. And the record date is, now record date is 2 days after the X right date. And then why the record date is because now they want to, on October 15, they see that who are the owners according to the register, and those owners will get so maybe it's going to issue in November or in December, but who is going to get it this right? Those who are registered, their names are registered on October 15. That's what we call it as a record date. So right on the price is 20 and 3.3 is the value of a right, and X right price is going to be down by the value of the right, and that's 16.67. We will discuss in detail in coming chapters about the right offerings. So standby writing, underwriters agreed to buy any shares that are not purchased through the right offerings. That is a possibility that you can do an underwriting standby underwriting agreement with the underwriters for if the right is not exercised by the existing shareholders. So who is going to buy this? Stockholders can either exercise their right or sell them. So there's two options now available with the stockholders, whether they exercise the right and buy a stock at the prescribed subscribed price, The other option is that they only sell the right in the market, and after the declaration announcement of the right, there is a possibility of a trading of only right. Now we calculated like this that the here we just mentioned that the value of the right is 3.3. So the existing stockholders can say, okay, I'm not want to buy the right or want to exercise the right. I just sell the rights, so that he can sell the rights of at this price. This for, in our example, the price. Stockholders can either exercise their right or sell them, and they are not hurt by the right offerings either way. Right offerings are generally cheaper, and until the early 1980s, right offers were the most popular method of raising new capital in Canada. And bought deals have replaced right offers as the prevalent form of equity. So bought deals now, the more investment banks are involved in the stock market, and by this way, they are doing more bought deals as compared to right issues. Dilution is a loss in value for existing shareholders with the right issue. Percentage ownership shares sold to the general public without a right offering. That's a dilution in percentage. Market value, firms negative NPV projects, and book value and EPS occurs when the market to book value is less than 1. Now, there is another way to raise capital for raise capital uh, for business is long-term debt. Long-term debt, and long-term debts are raised by issuing bonds. Bonds can be issued for 30 years, 20 years, 25 years, 10 years, 5 years. So bond, public issue of a long-term debt. That's a bond market. There's a possibility that we can issue the bonds private, and that's what we call it as a private issue. You issue the bonds to your friends or family members and generate uh, funding for the business with the promise that we will pay you this much of interest and we will return your money on that day after the expiry of the bonds. These are the terms of the loans that you have to follow. Direct business loan from commercial bank issues companies. That is also possible that we can borrow from financial institutions. Uh, Maturities varies from 1 to 5 year, but for borrowing, if you are borrowing from the banks, they are not long term, but bonds can be a long term. Repayable during life of the loan, so we can repay if you are not no more need of further borrowing funding. So private placements and similar to the term loan with the longer maturity. So these are the ways that term loans, private placements, or bonds. So these are the ways that the firms use to generate capital for the business, other than public offering or right offering, or do venture capital or go for a venture capital. So lower cost than public issue, private placements, or term loans or bonds. Uh, the only difference is that the loans or long-term debts are not creating any ownership in the business. So whether you make profit or loss, you have to return the amount what you borrowed in terms of bonds or term loans or private placements. You have to return it, whether you are making loss or making profit. And also as well that you have to pay the interest on it on top of the principal amount. But in case of a stocks, public offering to the stocks, public offering to the public, or right issue, or go to the venture capital, you are only going to give them the dividends if you are making profit. You are supposed to return the you are not supposed to return the money. If they want to disinvest, what they do, they go to the stock market and sell it. So this is the main difference between the equity, raising capital through equity, and raising capital through borrowing. Now, just a refreshing of what we discussed so far. What is venture capital and what type of firm receive it? Venture capital is initially for a small scale, providing capital to do a new business or to launch a new business. That's what we call it as a venture capital. What type of firms receive it? Those who are starting some new products or new ideas and all these things. What are some of the important services provided by underwriters? So underwriter are providing to carry on all the technical aspects of going to the public, setting the price for going to the public, and also provide the facility to sell the stock to the public, or they are also going to do this in a firm commitment that surety that we're going to buy if you are not able to sell it to the public. So what is IPO underpricing and why might it persist? So there is a possibility that IPOs are not able to generate the price what they want to sell it. But if you have a firm commitment underwriting, then there is no worries about it. Or then there is a possibility that you can generate some. What are some of the costs associated with issuing securities? So we just discussed the cost related to securities. What is the right offering and how do the value a right? We right offering is a issue of a share or a stock to the existing shareholders, and the value of the right is determined based on the market and the subscription price. What are some of the characteristics of private placement debt? We just discussed that the private placement debts is lower in similar to the term loan with a longer maturity, easier to renegotiate than public issues, and lower cost than the public issue. So these are the characteristics of a private placement. So if we so that's all what we want to discuss from this chapter. It's a short chapter. The main ideas of this chapter is to discuss how the firms or the corporations can raise their capital in order to start a new business or to expand the existing businesses. So we divide this, if we want to say in 1, 2, 3 way, what are the ways of raising capital? Venture capital, issue to the public, right issue, and the last one is through borrowing, long-term borrowing, and under long-term borrowing you can go for a bond issue, or you can go for a term loan, or you can go for a private placement. These are the ways that we can raise capital. uh, so I hope you like this, and if you have any question, you can contact me